All right, Happy New Year. It's January. The gyms are packed. Credit card statements are probably feeling a little bit scary after the holidays. And suddenly everyone remembers that we're about to be staring down the barrel of tax time. And every single year, homeowners miss the same money opportunities. It's not because they're bad with money by any means. It's not because they don't care. It's because they miss them because nobody really slows down and tells people, hey, did you actually check this stuff before you filed? Quick disclaimer, before the internet comes for me and before we go any further, I am not a CPA. This is not tax advice, and I'm not here to file your taxes for you, but I know enough to be a little bit dangerous. And that's why I want to share this with you. So this is really awareness, and my job is to help you ask better questions before it's too late. Because once you file that tax return, your window's closed. So if you own a home, use this as a simple checklist. Nothing fancy, just things that a lot of people skip by accident. So let's get into it. The first one, mortgage interest. Yes, it's deductible if you itemize. Every year I talk to homeowners who say, wait, that counts? And it does. Your lender literally sends you a form called a 1098 that shows exactly how much interest you paid every year. So you're gonna be getting those pretty shortly here. The government's not hiding it. Most people just don't look at it. So let's look at the next one. Property taxes. This one is actually sneaky. Because it's built into your monthly mortgage payments typically, it doesn't really feel like you're paying a tax, but you are paying it. But between property taxes, you can actually deduct up to $10,000 total under the SALT cap. You don't need to memorize the rule. Just make sure someone actually checks the number. Now let's talk points. So if you paid points when you bought or refinanced, this is one of the most commonly missed items I see. If you paid extra upfront to get a lower interest rate, those are called points. Now, depending on how your loan was structured, some or all of those loan points may be deductible. And people usually realize this in April and say, wait, I could have used that. Yes, but only if you look before filing. Now let's talk home office deduction. So you're self-employed, right? Let's keep this simple and honest. If your office is your couch, your bed, or maybe Starbucks, this probably doesn't apply. But if you're self-employed and you have a specific room or space used only for work, that may count. Keyword, exclusive, not sometimes. So make sure you be honest, be accurate, and don't push it. And now let's talk energy upgrades. Solar panels, new windows, HVAC systems, insulation. These aren't deductions, they're actually credits, and there's a big difference. A deduction lowers the income you're taxed on. A credit actually lowers your tax bill dollar for dollar. So if you made energy upgrades and didn't check this, that's real money you could be leaving on the table. Now, if you sold your primary home, this one is big. If you lived in the home for long enough, you may be able to exclude up to $250,000 in capital gains taxes if you're single, or $500,000 if you're married. That means no capital gains tax on that portion of your profit. And this is the biggest tax break most homeowners ever get. And it only works if the rules are followed correctly. Next, let's look at rental properties. So even small landlords sometimes miss these things here. If you own a rental home, you may be able to deduct interest, property taxes, insurance, repairs, management fees. A big one is that depreciation. If your rental taxes feel easy, it might be a sign something was maybe missed, so double check them. This next one is a pretty big one. HELOC interest. The rules changed a few years ago, and this one confuses a lot of people because mortgage interest should be tax deductible, right? But your interest may only be deductible if the money was used to improve the home that the loan was tied to. If it was used to pay off credit cards or you funded lifestyle stuff or toys, it usually doesn't count. So same rule or same loan, different use, different rules. And quick Florida note, Florida does not have a state income tax, so things like 529 contributions don't get a state deduction. But federally, they can still be very powerful. Same idea with retirement contributions. Depending on the account, you may still have time to lower last year's taxable income. So we're talking 401ks, IRAs. You can count your contribution to your retirement account against 2025 up until April 2026. So even though the year already ended, you could still apply it to your 2025. So deadlines really matter here. And the last one, your W-4. If you owed a lot of money or you got a refund pretty big and it felt like a surprise bonus, your withholding is probably off. And that's not really a tax problem, but that's really kind of more of a planning problem. And fixing it now can change your paycheck, every single bi-weekly paycheck, and not just fixing it for next year. So none of this stuff is really complicated. It's just easy to ignore. And the people who do well with money aren't really smarter than everyone else. They're just more intentional and they double check. So don't rush to file just to be done with it. That's what we all want to do, right? Review it first, use this checklist, ask better questions, and if homeownership or equity plays a role in your 2026 plans, I'm always here as a resource. So hit that like button, subscribe, and follow me for more helpful tips.